Anyways. Anywho, welcome to Forex.Today. What are we going to do? How about some dollar pairs, some yen pairs? How about some, we can do gold, oil, and Bitcoin. Boy, there's a lot that we can do today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money cannot afford to lose. Ahmed says, Aussie dollar, please. Well, I'm happy to cover that, Ahmed. We'll have to talk about the RBA only raising interest rates by 25 basis points. That's it? That's it, really? All right, so we can take a look at Aussie. Anything else that you'd like me to cover? I'm happy to do that. Remember, you're the boss. I'm the servant. I'm here to serve you. Let me know what you need. I aim to please. We can talk about technical analysis. We could talk about fundamental analysis. We could talk about trader psychology. Those are the three subjects of my next 3 books, by the way. It's a trilogy. Oh, spoiler alert. Yeah, very cool, right? Yeah, baby. So let me know how I can help. I've learned a few things over the last 20 years. Before I was in Forex, I was in the high-tech startup business as an entrepreneur, and then later as an investor. I also helped many startups raise millions of dollars. And I thought I was pretty happy. Like, think of it. I was, 30 or something. And I received coverage in magazines like Inc. magazine, like Red Herring magazine, like the National Post of Canada, which is the newspaper that is sold across the entire country of Canada, which me being Canadian is really amazing. I call up my mom. I'm like, Mom, I'm in the National Post. And not like a blurb, but an entire article. It was called The Canadian Brain Drain. And they were talking about, Canadians like myself, why they are leaving to make their fortunes in America. Right? So anyway, I thought I was in that peak. I became a venture capitalist. We had an awesome firm. I was talking to about 5 entrepreneurs a day, getting pitches and all that kind of stuff. I had a research team. I had 2 assistants. And, dude, that's pretty good at 30, right? Like, I'm loving life and living large. And I ran into this thing called Forex. Just blew me away because they said it was $100 billion a day, or $1 trillion a day. $2 trillion a day, something like that. And I'm like, dude, I'm a smart guy. That's stupid. What a scam. It can't be real. And sure enough, I looked it up and it was true. $2 trillion a day in the foreign exchange market. And here I was, an idiot, trying to find $1 billion a year market to invest in. $1 billion? That's it? $1 billion a year? Where Forex is $2 trillion a day? Well, now it's $6 trillion a day. So at least I was smart enough where I thought I was I was going to be a venture capitalist the rest of my life. And I gave it all away for a better opportunity. And trust me, up to that point, I read thousands of business plans. And my conclusion of reading thousands of business plans and thousands of patents, because we only invested into patented ideas, right? After all of that, Forex is by far the best investment you can make as a business. Okay? Emerald says, hey, you are the servant and the boss. Well, hey. That's what happens when you're an ex-supermodel like myself. I'm the chairman of the board of the International Association of Retired Male Supermodels. So it carries a lot of weight and responsibility, Emerald. So anyway, look, here's what I'm trying to say. I've been around. I've done some things. Forex is not my first rodeo. And you know what? This is good. You will not find a better opportunity in front of you. Okay, believe you me. And you know, I put 20 years into this, so it shows you how awesome the opportunity you have in front of you. So again, let me know how it can help. So we'll go through the charts today, and that's great. There's about, what, 5,000 or 6,000 videos. By the way, I noticed the YouTube has deleted thousands and thousands of my videos. What's up with that? Is that happening to anybody else? Like, my videos from 2004 and 2005 are gone. Or maybe it was older than that. 2006, 2007, I think, is when I was a beta tester. They're just gone now. Just gone. Like, wait, what? They're gone. It's amazing. But anyways, yeah, I mean, seriously, right? It's not my property, right? I guess if I upload it to YouTube, it's YouTube's property and not my property. I don't know the intellectual rights of that. I guess if you post on Facebook, it belongs to Facebook, right? So anyways, so I've done thousands and thousands and thousands and thousands and thousands of videos on YouTube. They're all free. There's training courses on youtube.com/FXBootcamp. Really good stuff. I co-hosted those with FXCM. They promoted them heavily. There's hundreds of thousands of views, which is pretty good, again, for Forex. And they're pretty good. No holds barred. You'll get real information, not a sales pitch. So go check that out. That's free, right, on the FX Bootcamp YouTube channel. Here, there's thousands of you. I think we're at about 2,000 videos for Forex.Today. Watch all of those. Look, if you have a little bit of money, you can buy my book. If you have a little bit of money, you can get 65 hours of training videos at fxbootcamp.com. There's a plethora, a cornucopia of resources made available to help you succeed as a currency trader. But you got to take the next step. You got to do it yourself. You got to reach out. I'm here every day, but you still need to do action. I do the action every day. You need to follow that up. And I know many of you do. You'll also need a trustworthy, ethical foreign exchange broker to execute your trades for you. I recommend tradersway.com. The link is in below. If you're worried that you click, I'm only doing that so that you get some sort of, introducing broker commission. You're like, Wayne, you're only saying that for commissions. Don't click the link, bro. Don't tell them I sent you. Just sneak in. It doesn't matter to me. I recommend them because of their actions. Okay? Again, major brokers went out of business when the Swiss National Bank surprised everybody, pulled their peg. Brokers went out of business. Traders Way was just fine. Boom. Loyalty and respect earned. So, take my word for it or don't. It's up to you. Kyle says, you're wrong on the 65 hours, I think. It has to be more. Yeah, probably. Yeah. Yeah, probably, huh? Yep. Yeah. I don't know. Look, it's $88. Right? It's amazing. Like, I'm here to help, truly. Right? I'm here to help. But if someone's not willing to pay $88 for 65 hours or more of really hardcore training videos, then I don't know how it can help besides these free webinars. Yeah. So look, if you ain't got no money, I'm still here. I still want you to succeed. But look, let's cut to the chase. I'm trying to make you a conservative, disciplined, independently thinking foreign exchange trader. I don't want you to get rich because, okay, where's my drawing tool? Let's just get this out of the way. I've been teaching, almost everybody here knows this, but hey, you might be brand new or maybe some new guy is watching a recording of this, right? Okay? Reward is a function of risk. So, to say it in English, the only way you can get rich quick trading anything, but we'll talk about Forex. The only way for you to get rich quick trading Forex is take a lot of risk. And you will fail. You cannot. It's against the laws of nature. Do you understand that? It's against the laws of nature for you to get rich quick. It doesn't equate. Because the more risk you take, the more likely you will fail. So the faster you want to get rich, the faster you're likely to get poor. So I'm trying to stop that nonsense right away. And as an entrepreneur, as an investor before Forex, I bring this idea that Forex is a small business. Small businesses need plans, they need products, they need service, they even need visions. Okay? For the type of small business they are and where they are going to be in the future, you have to think 2, 3, 4, 5 years in advance if you're going to survive today and tomorrow. And I don't necessarily mean predicting what the market is, but you have to have the mindset that your goal is to simply be able to get to year 5 or year 10. Slowly building wealth or net worth, account size, AUM. It's really important because you got to have that mindset first. And in my early days, after I quit my job as a VC, after working, almost 20 hours a day, in particular all night, in my early days as a Forex trader, I did run into a tough patch, we'll call it, a rough patch. Okay, I sucked for a while, and I think it was because I was falling into depression. It's hard trading all night, as many of you guys know. So I backed off and I said, Wayne, why am I not as successful as I think I should be? And before I had been successful before as an investor, okay, as an entrepreneur, even in the nonprofit world, okay, I had always been a success. So I asked myself, why am I struggling now as an independent Forex trader? And I realized that I didn't have a plan. I literally didn't have a business plan. I didn't have a vision. I was just trying to make as much money as I could every day. But that's not how you run a business, right? So anyway, I did that business planning retreat. And I'm telling you, one of the major things after doing a business planning retreat and actually writing plans and actually doing the financial analysis and all this stuff, the biggest thing that ever happened to me in my Forex career is I came back from that business planning retreat realizing that all I had to do is achieve daily mediocrity, let's say the average, every day. And at the end of the year, at the end of 3 years, at the end of 5 years, I'm achieving huge goals. That there was no need to get rich quick. What I needed to do is just produce consistent, reliable, low-risk results over periods of time, and my account size would naturally grow. And I got away from the risk. Mediocrity was enough. It was assets under management over, with consistent growth over time. The math said I didn't need the risk. And so that's the biggest thing I can give you, is to get you away from the get rich mentality and instead focus on developing value, doing analysis, planning your trades, reducing your risk, looking for consistency. And so when you go into a week like this week, where there's all kinds of crosswinds, what is the the Central Bank of Australia doing? What's the Central Bank of England doing? What's the Central Bank of the United States doing? What's the, all this stuff. Oh, we got non-farm payrolls. We got this, and we got the election next week. Oh my goodness. Probably not the best opportunity. The market conditions are probably not the best opportunity to get rich quick. Okay? Cranky Bit says, hey, it took me 6 to 7 years to realize that myself. An eye-opener for sure. Yeah, Cranky Bits. Olive's, or is it Clive? Sorry, Clive. Wayne, is capital funding as a trader important? Well, look, here's the math, right? You start with, okay, assets under management times, okay, how would you do this? Average pips per trade. We'll just say times month over month percent. How about that? Okay. Over time. Okay. So, what can you impact here? I'm trying to say that you should extend your time horizon. Okay? Keep this consistent and low. You don't want big month-over-month returns, because the only way you can have big month-over-month returns is to take big risk, but I'm trying to get you to be anti-risk. Okay? So the more time you could trade, like for example, if you're 70 now, I don't think you're going to be trading when you're 90. If you're 30 now, you could be a full-time Forex trader for 30 or 40 more years. So you got more time. That's great. That's working for you. You want to keep this modest as possible, consistent and modest. So the only thing that changes then is your assets under management. So if you start with $1,000, $10,000, okay, $100,000, okay. Does it matter? Yeah. It does matter. Yeah, it does matter. Okay? It does matter. So, this is where at some point I would recommend every trader that has developed consistency over time to develop a side hustle. Now, maybe that's working at Starbucks so you can eat the day-old muffins, okay, and get free Wi-Fi. And maybe if you're full-time, you can get some health insurance. Okay, you could do that. Or you can become a professional money manager and trade Forex for other people, because it's a form of increasing your AUM. Now, the best part of that now, if we're going to focus on that, that's interesting, because what you do is, let's say you start with your 10,000 of your own money. That's your assets under management. Okay? And then you start your side hustle, trading other people's money. And you get to keep 20% of your profits. So if your 20% adds up to your monthly needs, so let's say trading Forex for other people, you only get to keep 20%, but it pays your mortgage. Okay? It puts food on the table. Okay? But the thing is, if you're doing 6% a month, let's say you're amazing. Okay? If you're doing 6% a month, you're doubling your account every year. Wait, what? Okay? That's just to make the math easy. I don't think you should be trying for 6% a month, but let's say you did. So in that case, in year one, you grew your account to your personal account to 20,000. And then in year two, you grew it to 40,000. Year 3, you grew it to 80,000. Then where are we now? Year 4, 160,000. Year 5, 320,000. Year 6, 640,000. Okay? So around year 7, year 8, you hit the $1 million mark. Meanwhile, you're still just trading other people's money. And of course, that AUM will grow and you'll make a little bit more than you need here. Everything's fine. But the key point to the side hustle now is that you never touch your money. That's where you make your big cash. It's one of the many paradoxes of being an investor. The less you pay yourself, the more money you'll make. Okay? So anyway, there's all that. But the thing is, you'll never get the side hustle if you're trying to get rich quick. It's just, you don't have the right mindset. So please, okay, please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Could you please do that? Yeah. And I know that most of you are already there. I was asked today if the Forex.Today community was a community of loyal traders focused on trading successfully and not getting rich quick. Is that the right description for you guys? Are we a loyal community of serious traders treating Forex as a business with an adult mindset? Is that the right description? They wondered. They're like, well, I don't know. I'm like, well, I don't know. I've only known some of the people in our community for 15 or 16 years. I'm like, I don't know. Yeah. JR says, yeah, Forex is kind of hard to fully grasp. Oh, for sure. Yeah. Is that right, Maida? Yeah, nothing's going to stop Maida for sure. I'm telling you, like I said, the toughest guy I ever met was a Cuban, and he was tiny because he was so old. He was like 200 years old. He was so tiny, and he was just he had dark skin because he worked outside all the time. He was 200 years old. He walked around with no shirt on all day, every day. He's outside. And like I said, the day that I went over to his house, he had dug a hole around a stump in his backyard from a fruit tree that died. So he cut the fruit tree down, dug out around the stump, and he was hacking away at the roots with an axe. I'm telling you, a 20-year-old couldn't do that. That's like some of the most physical work you could probably ever do. Like, if you don't know, the root of a tree is like stone. It's so dense, it's unbelievable. And there's this guy, he's 200 years old, he's smoking a cigar, he's chopping out the roots and everything. It's just like, toughest guy, I'm telling you. Live forever. Anyways, you guys ready to go on? Let's move on. Let's do some, let's do commodities. Let's do commodities. Gold, oil, and Bitcoin. Let's roll. I got to move. Give me the juice. Okay. All right. Look at the big comeback here on gold, huh? Holy smokes. Just out of nowhere. Boom, 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 boom. Okay. Holy smokes, eh? All right. So what's going on? How do we read this chart? Let's maybe get rid of these channels. Okay, just am I able to? How come it's not grabbing it? There we go. Oh, the name is on it. Ugh. All right, so how are we going to break this down? Let's put it into digestible pieces. Okay. The first thing I notice is it did make a lower low relative to that. Does that matter? Yes, it does, because then it sets up something that we call a crown pattern if you like to trade patterns. Okay? Think of it as a head and shoulders, okay, with the sloped neckline. So now you get sort of like the neckline is here, you get a slope here, and then you probably slope over here. Okay. Now, really, if I always trade it like a head and shoulders. So to me, it doesn't matter. So I always look at it horizontally. I'm not a trend line guy, so to speak. You know, like I really don't typically, right, draw something like that and say, oh, it's going to have to follow that. But it might. Okay, totally could. But that's kind of how you look at this. Okay, you look at it this way. Normally with the head and shoulders, right, you would do, okay, you get your crown and then you kick off the top, right? That's how you do a head and shoulders. But technically, because of that lower low, we call that a crown. And so the right shoulder tends to be lower than the left shoulder. If you were a bear. Now, you might not be a bear. And then I'm like, forget about it. See, we're still in that mode where I believe going into the FOMC decision tomorrow, non-farm payrolls Friday, the election on Tuesday, that there's still more money coming out of the market than going in. And remember, the market was net short the stock market, which would be net long the US dollar. So if money is coming out of those positions, then the opposite would happen, and therefore suddenly USD gets weak. Okay, so one could argue, if that is true, then maybe this starts to happen in the near future. But you know what? That could be a week from now. Okay, so, but if you're a bull, this would be a terrible time to buy because of that potential. Okay. Now, like I said, I'm not really a trend line guy. I don't really make a big distinction between a crown pattern and a head and shoulders pattern and the three pregnant nun pattern. Like, I'm not a big pattern guy. I like logic. I don't like tricks. To me, some of that is tricks. So what I look at is things like this monthly pivot here in blue, right? This monthly pivot, to me, is technically important. Okay, so if it were me, I would still think it would do something like that if I was a bear. Okay, the second order here is if we go a little further up, okay, you can see that the next sell zone on the longer time frame for gold is up at 1680. So 1660 to 1680 is the sell zone. You can see that there might have been a front run in here. So the top is currently right in the middle of that. So the way I would look at it still is potentially this or potentially this. Basically, we can call that a double top. And the double top idea would probably be after the election. Okay. Okay. So anyway, so be careful, be careful, be careful. If you are selling gold, it's because we are in a deflationary period. Once again, you might say, well, Wayne, I thought we were in an inflationary period. No, we're in a deflationary period of central bank policy. The central bank policies around the world are such that they are trying to create disinflation. They're trying to reduce inflation. And in a world of central bank policy of creating disinflation, gold tends to weaken. It got strong when we had inflation and inflation was growing. Okay? And this might be based on Europe, right? Did you see the inflation data out of Europe? It's still red hot. Okay? But the ECB is trying to kill it. The Fed is trying to kill it. The Bank of England is trying to kill it. The Bank of Japan is trying to kill it. The People's Bank of China is trying to kill it. Right? The RBA. Right? The BOC. Those central banks are trying to kill it. Okay? So that would be that. Now, if you want to play the shorter term price action, what does it say? Like, should you be a buyer or seller? Well, on a 1 hour, it's slightly more bearish than bullish. It's neither here nor there. We're not at a really good price for selling. If you were going to buy it, you'd have to buy a dip back into the moving averages and then take it up like this. That would be the bullish play. And bears really shouldn't sell until we're back up to here, in my opinion. And you're like, well, it's kind of neither of those. Yeah, well, you know what? Tomorrow's a big risk event. And professionals don't throw down money before a big risk event. And I'm trying to get you to understand market behavior. So think about that. The market participants, institutional market participants, are risk averse by nature. They're looking for low volatility and consistent returns. So they look at this week and they say, can we get low volatility and consistent returns this week? And the answer is no. That was a question they asked a week ago, by the way. Maybe even 2 weeks ago. And they got together in their committee meeting and they're like, no, we think volatility is going to go up and the consistent trend is going to diminish. So they say, well, the prudent thing to do is reduce our exposure to the risk. That's probably the meeting they had 2 weeks ago. And that's what you see now in the market. Okay? And I'm trying to get you to think that way too. Consistent returns with low volatility. That's called a Sharpe ratio. Okay? Okay. Named for by Bill Sharpe. Okay. Oh. Something popped up. There we go. All right. There we go. I don't know anything about this website. I just randomly pulled it up. Okay. Now, there's many different ways to calculate this, by the way. The Sharpe ratio. Joseph, I talked about that yesterday about the PMI. It's the manufacturing PMI, but I want you to look at the employment subcomponent. I want you to look at the inventory subcomponent. Okay, and new order subcomponent. Okay, but watch yesterday's video if you want to take a look at that. Okay, so you want to take your return as a trader, let's say over a month or over a quarter or over a year. Okay, the longer term, the better, because you get a smoother number. Okay, so you want to look at the return you got minus the risk-free rate of return, which is usually the yield on the 10-year T-note, and that's the opportunity cost. See, an investor could invest into your portfolio, but they could have just bought the 10-year T-note and been guaranteed 4%. So if you did 10% over a year, well, they could have got 4% not investing with you. So your real return, right, is 6. Now, that doesn't account for how much risk was seen in the portfolio. This is important because a trader might say, look, I made 10% last year. And the investor says, oh, that's pretty good. I'm interested in a return of 10%. But what if the trader was losing money 11 months in a row, but on the 12th month, right at the end of the year, when everything was calculated, they took a big bet, okay, gambled the whole thing, and ended December 31st with a 10% return. Is that relative information to a potential investor? Should they know that you were losing 11 months in a row, but on the 12th month, you returned the 10%? Is that relevant information? Should the investor know that? Should you disclose? Yeah, very much relevant, isn't it? Very, very much. So we call that risk-adjusted returns because the investor wants to know that it wasn't just a random good number based on the calculation, because they want to know really, they're not, the number one concern to a sophisticated investor is not your return, but what's the risk that in January you're down 10%? They don't want a trader that's down 10%, up 10%, down 10%, up 10%, down 10%, up 10%. You don't want that. So you need to do risk-adjusted performance analysis of your traders. And this is in particular used when you're comparing 10 different Forex traders. One of them made 10,000, the other made 100,000, the other one made 3,000, the other one, right? Or one made 10%, the other one made 30%, the other made 5%, the other one made 17%. Well, how do you compare these apples? And then what if you're comparing an apple with an orange? Like, how about a futures trader versus a Forex trader? Or what about investing into an apartment building? What kind of return? Okay, especially risk-adjusted return, so that you can compare the apartment building investment with the commodities trader investment, with the Forex trader investment, and you dumb it all down to the return for the risk. Okay, so you want to look at the standard deviation of the portfolio's return. Standard deviation, again, okay, how do you calculate standard deviation? Let's say this was your 1 year of trading. Okay. How do you calculate the standard deviation? Well, let me explain the math. Okay. You want to find the rise over the run for the mean. Okay. So you do the rise over run. Okay. Right? Rise over run equals M. Okay. So the first thing you have to do is, that's the slope of the mean. So you have to then, for every, let's say this is every day for a year, you have to calculate the average, the average, the average, the average, the average, the average. Okay? The average, the average. And the average is going to end up looking like that. Every day you calculate the new average. 1 plus 1, okay? 1 plus 1 plus 1 divided by 3, okay? And you get the average value of the portfolio over that period of time. So it's just a data set, okay? Then you calculate the variance. So price went that far, price went that far, okay? Price went that far. These are sort of the outliers, okay? Price went that far, price went that far, away from the mean, okay? So now you calculate the variance of how far price tends to deviate from the mean. Okay, and then you want the standard deviation, which means you have to take the square root of the variation, and you get the standard deviation so that you get standard deviation above and below the mean, capturing 95% of the price action, okay? So you look at that, and the more you deviate, so let's say another trader has outliers, okay? So let's say that's trader number 1. Trader number 2, their outliers are like way out here and way out here, which means they go negative 30 and then they go plus 45 in the period of several months, and then back, then they go through another period of negative 20. Well, that bigger variance or standard deviation tells the investor that you don't really know if next month you're going to be up 30% or down 30%. Do you understand that? Like, they're like, it's almost a crapshoot. You're either going to be way up or you're going to be way down. Well, what does that tell you? Risk. Yeah, you might be up 30% and all your other traders are only up 5 or 6%. So you're like, oh my God, I want to invest into the trader that's got a portfolio that's up 30% in profit, right? Well, not if it's going to be down 30% next month. And what if there's 3 months in a row of negative returns? You're almost out. You're almost broke in less than 3 months. Why? Return is a function of risk, or risk is a function of return. So you're like, you're getting high returns, but look at the risk. Boom or bust. Is that really what you want to do? Is that really what an institutional investor wants to do? No, of course not, right? So that's how you start calculating the returns of various other traders or investment opportunities. Like I said, it could be a commodities trader, a stock trader, a real estate investment opportunity. You want to calculate the average over time, the slope of the average, the variance from the slope, and then the standard deviation to determine how much risk is actually in the portfolio. How much ups and downs are there in the portfolio for you to make money? And the more up and down, the worse it is. Just think about it like if you're sailing on a calm sea, the waves are very small. You just catch the breeze and the sun is warm on your face and you just sail. Now, it's not very exciting, maybe. It could even be a little bit boring, just cruising around doing 8 knots or whatever it is, 8 knots, 5 knots, whatever. Whatever's just slow and steady, steady and slow. Hey, eventually you're going to cross the ocean and you're probably going to read a lot of books. It'll be really boring, but it won't be dangerous. Or do you want the rough seas and thunder and lightning and swells, right? Nose to the wind. It's very exciting. You might die at any moment, or you'll live to tell the tale. But is that what you want? So that's why we do risk-adjusted performance. I mention this now because I want you to, if you understand the math, then you can adjust your trading appropriately. Or at least you can think about your trading. Are you trading so that you have a lower standard deviation, a lower variance. First of all, I hope you realize that the first thing you want to see is a positive slope, not a negative slope. Negative slope means you've been losing money. Okay? Okay? A potential investor is not trying to decide, okay, is this person profitable or not? Dude, if you're not profitable, you're not going to raise money. So everybody's profitable. Do you understand that? You can be in a room. Like, put it this way. What if I got you in front of 300 potential investors? These are all accredited investors, and they're all interested in putting some money into the fund of an emerging manager like yourself. By the way, I used to do this. I used to do this with startups. I used to bring in probably close to 250 venture capitalists and well-known angel investors in the Silicon Valley. And we'd bring in 8 to 10 startups that already had a little bit of a track record, but they're a young team. So they were looking for seed level angel type money. And so they would do the presentation in front of this group. It was closed door. You had to be invited, and it was ultra exclusive, but you got a t-shirt. Okay. And the one I'm thinking about in particular, it was only young startups that had people that used to work at Oracle. So the founders of these companies used to work at Oracle, a big database company. So it was very, very specific. So you can imagine that I could do this for a Forex firm, right? Where all you have is a 3-year track record and hardly any money. But you might give favorable terms to your first few investors, right? The thing is, how would an investor sitting in that audience, if they heard 10 or 12 pitches from young Forex traders, how do they decide? Personality of the presenter? Yep. Quality of the presentation? Yep. All these things matter. The way that you look and walk and talk? Yeah, it matters. But then they're going to look at the facts. They're like, oh, that guy sounds great, or she sounds amazing. Then they pull up your track record and you got a Sharp of 0.3. Pass. You're dead. Okay? Or it could be high, 4.2. And they're like, what the is going on here? That can't be right. That can't be right. They're like, that can't be right. There's something there. So you look, a high Sharp ratio is better than a low Sharp ratio because it still means you're making more money than the risk you're taking. But a high Sharp ratio like 4, they're going to go, oh my God, what's going on here? That can't be right. There's something messed up. And it might be that you didn't discount your returns with the risk-free rate of return. And you're like, oh, we'll recalculate it. And you're like, oh, well, it's still 1.8. And you're like, that's still really good. Okay. And so that's how it gets to it. Yes, you have to have the right look and talk and walk. Okay. Sound right, smell right, look right. I don't know. All those, the body language matters. It does matter ultimately, because no one's going to invest in you if they don't like you or trust you. But ultimately, you also have to have the right numbers. So I want to teach you how to be conservative and disciplined, developing consistent returns with low volatility. Which means maybe don't overtrade this week when you're almost guaranteed high volatility. Do you understand that? I know you probably think that I should be going, rah, 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 go, go, go. Let's all trade, trade, trade. That's what the kids on YouTube are doing. So I hope you appreciate the honesty. Okay? It's important to have an idea of longevity and conservatism, I believe. Yeah. And so that's the message I'm trying to give you. To be patient, be disciplined, be conservative. Trader's Way has never once said to me, hey, can you get traders to trade more? Can you get our clients to trade more? Can you increase the volume? Can you get them to trade, 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 go, 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 scalp, 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 flip, 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 go, go, go? They've never once asked me to do that. You would think a broker would want that. That's how they make money. But they realize that the better business model is for you to trade conservatively over years, or over a period of years, slowly building your trading account. I'm like, that's a good business model. Okay, taking a look at Bitcoin. Okay, and still nothing. Okay, neutral. We've been watching this in the day trading group for days, and I'm like, this smells like neutrality to me. This doesn't say risk on. This doesn't say load the boat. This doesn't say the stock market's going to rise 10%. This tells me money's coming out of the market, and people are either confused or shy or averse or just simply not trading right now. So I would look at this and say, oh my gosh, be careful. Okay? Remember, most retail traders will lose money during periods of low volatility and high volatility. Okay? Throwing down 4 or 5 bad trades right now and losing 100 pips is the same as throwing down one bad trade with high volatility, let's say after the election, and losing 100 pips on the high volatility. Morning, Anthony. How you doing, buddy? Yeah, fortune favors the brave. You sound like Matt Damon. I might be a movie star, but I know about crypto. Life is good. Life is great. Life is beautiful. Hey, Anthony, I was asked if our community here at Forex.Today is loyal and is focused and disciplined, focused on the long term, focused on trading profitably, not in versus getting rich quick. What's your thought on that? Does that describe us? Exactly. Yep. Yep. Perfect description of our community. Yeah. But they had to ask, of course. Man, I'm itching to travel like you wouldn't believe. Am I allowed to go to Hong Kong? I want to go to Hong Kong. Like, I want to go like next week. Is next week Thanksgiving? I don't think so. I want to go to Hong Kong for like 2 days and then come home. ISM 50.2 versus 50 expected. Oh, that's great news, hey, Jim? All right, let's look at the subcomponents. Am I allowed to fly to Hong Kong or maybe just Singapore? You know what? Maybe I'll fly to Singapore. It's even farther and it's warmer. I'll pop in and say hi to Jim Rogers. Okay, let's take a look. Oh, did I click services? What a dum-dum. What a ninkau poop. There we go. 50.9. Where'd you get 50.2? Is this old? What? Did I click on the wrong one? Wait, am I having a brain fart? Manufacturing. CNBC said that? Well, let's try it. If I'm having a brain fart, let me know. Sometimes it's hard to do all these things. Okay, sometimes it's hard to do both. So I think this is right. And all right. So even if it's the wrong month, really? For October, maybe I'm cached. Hang on. No, it's not services. I knew it was. Huh. Is it wrong or what? What's going on? Talk to me, Goose. Yeah, last month was 50.9. Yeah, but why isn't it updated on their site? So anyways, poo-poo on them, huh? So let's trying to see if there's like a press release version. Advertise, career. Media relations, press releases. What's going on, ISM? ISM report on business. Okay, so there we go. So now they've updated it. Let's see. Haha, there we go. Too fast. I'm sorry. I have to apologize. I was too fast. This is very insensitive of me. Okay, so we're going to break this down into digestible pieces. Make sure you chew your economic data. Okay, let's take a look here. All right. So we want to look at new orders. And new orders are better than before, but are still bad. You see that? An improvement in new orders. Customers are buying. Although it is a bad number. Employment improved and is basically a break-even number. But it's not getting smaller. It did get better. Remember, the Fed is expecting, like let's step back a bit. Let's talk about the thesis. The Fed is trying to kill inflation by slowing the economy. Okay? Orders have improved, which means consumers are buying. Companies are hiring. Inventories are falling, which means we'll have to build up. People are buying the inventory, and the companies will have to manufacture some more inventory. Okay? So that is not the economy slowing. Although prices are down, and pretty significant. A pretty significant fall in price. Maybe because there was a liquidation of inventory. Remember, like Amazon.com and a bunch of retail, especially like clothing retail, they had way too much inventory. I mean, even Apple has trouble selling iPhones, right? So maybe there was some discounting here, dwindling down inventory, and prices are falling. But now if there's a shortage of inventory, prices are likely to stabilize. So right? Look at the, right? So anyways, you could look at this, and some of the first stuff here kind of shows the Fed will need to raise interest rates higher than previously expected. Although they could just be blips in the matrix. Okay, new orders has only been, right, expanding for 2 months. Employment, right, that kind of stuff, that's new, that's only 1 month. Okay. Inventory's falling. That's been over a year. So anyways, so you could argue that some of this shows that the Fed will have to continue with a policy that will reduce employment and reduce new orders. But luckily, prices are falling. So, okay, a bit of a mixed bag, but not I would say still fairly pro-US dollar. Okay. Was that helpful, going through the information that way? How to read into the numbers? I don't care about the headline. We're trying to predict the future, not report on the past. Okay, So we go to like, let's pick on Aussie dollar. Let's pick on Aussie dollar. Okay. What this says, first of all, Australia only raised by 25 basis points. So that's disappointing relative to its peers. So Aussie would weaken. But now we're looking at it like the question being asked now, today, has to do with the FOMC decision tomorrow, which is a really dumb way of the market doing it, but this is what the market does. The market's not necessarily smart. The market is made of a lot of different participants. And they're saying, they're trading in a way that suggests that they think the Fed is going to raise interest rates tomorrow, but then announce a shift in policy, maybe a slowing down of the rate at which they hike interest rates, known as a pivot. So now they get this report come out from the ISM manufacturing. By the way, it's not even the important report. The important report is the services one. But nonetheless, the market is what the market is. The market's going to do what the market do. And so they read into it right now, and what they just read was, oh my God, the Fed is not going to pivot. Okay? Which is getting us down to potential entries that we have set up days ago, by the way. Days ago. So if we go back to gold, which we've already done today. Oh, by the way, can you take a second to click the thumbs up button? Just let YouTube know that you're not a bot. Okay? And I'd also like to thank you. The average person has been in this webinar for 22 minutes. That's ridiculously amazing for YouTube. So thank you. You're ridiculously amazing. Let us go to gold. Let me expand this out a little bit. Let's go back to gold. Okay. And there's that scenario that we were talking about earlier. If you're a bull, you should get ready. That bearish zone was above us. There's that whole crown pattern. And by the way, if you want to follow up with the crown pattern, this is what you do. Okay. The first thing you got to do is identify your neckline. And then you identify your crown, the peak of the crown. Okay. I'm going to measure it this way. Okay. Okay. Now, if the peak was over here, it would have given a slightly different number, but that's okay. And then we drag this across and make it a projection off the break of that neckline. And that gets us there. So plan A would be there to there. You follow? Now, I will continue this with price action. I would say then we come back to about here. Next week, of course. Now we're into next week. And that the current projection for gold is $1,550. If this continues over the next couple of weeks. Okay. So once again, I don't care about the news. 50.2 on ISM manufacturing. It's not really relevant. What we're trying to predict is what will the market be doing 6 to 12 months from now. So we're looking at the trends inside of the data, but also we're translating that to interpret what the Fed will do next. Fundamental analysis is the study of trends in macroeconomic data with the purpose of discerning central banking policy of each economy. And then, of course, playing the economies against each other. You got to buy one and sell the other. So right now, we're selling contracting economies and buying the reserve currency. Now, you might say, well, the United States ain't doing that great too, so why would the dollar be strong? No, you're thinking about it wrong. Think of it just as this. Investors are selling contracting economies and then buying the reserve currency. And you're like, why? Because it's a reserve currency. That's what makes it a reserve currency. By definition, if global economic conditions are contracting, then you buy the reserve currency. If you buy something else, then that's the reserve currency. There's no law. There's no court somewhere. It's not the World Trade Organization or the United Nations that sets the US dollar as a reserve currency. It's free will. So if we go into a global recession and the dollar gets strong, then the dollar is the reserve currency. Okay? It's kind of interesting, huh? So this is what we're trying to do. This is what we're trying to do. All right. Okay. All right. Hey, did you have a chance to do that Twitter poll that I sent out about the book I'm writing? Or books? I'm actually going to write books. If you're going to do it right. Like they say in Dubai, if one will do 3. I'll show you how super simple it is. Super simple. It'll take you 1 second. Okay? I'll even bring it up specifically on its page. I'm starting to write another book about investing and trading, not just Forex, but stocks, bonds, gold, oil, and Bitcoin. What subject matter would interest you most? That's it. And you just click one. Literally 1 second. And if you'd be so kind to let me know what you think, I'd appreciate it. Okay? Richard says, hey, so you're saying that since global recession, since global recession fears are gloomy, investors flock to safe haven assets? Yeah. And that traditionally would include Japanese yen, which is not happening. And that is very, 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 very interesting. The Japanese yen has lost its pseudo reserve currency status. Okay. I was asked about WTI. Well, this week I've been doing Brent. So let's just do Brent instead, just to follow up with what I've already said in the past. Okay, let me drop it into a 1 hour, which I've done here. What I did is I analyzed old resistance. Okay, we did this on Sunday, by the way. What is it today, Tuesday? I did this on Sunday. So we were here. Okay, so we had a higher high. Boy, that looks like AA. I tried to make that HH. And it had given back on Friday. And so on Sunday, I identified this as the buy zone where all bulls will buy. Here's the thing. You ready for it? Wait for it. This is the price where bears will sell. And we talked about that on Sunday as well. So we knew here that bulls are going to buy in this zone. I mean, specifically, let me do it this way. Specifically, this is the price I would assume bulls would buy. This is the price I would assume bears would sell. And they have done both. There are bulls and there are bears in the market. Which one's going to win? Well, I don't know the future, but my bias is bullish for oil. I am a bull on oil. Okay, cool. So do you buy here? No, actually today's day trading plan, by the way. This is the day trade plan. Can you see? It's actually on the charts. You see this? Bullish buy zone right here. If you don't know how to day trade, you need to join FX Bootcamp. One of the many courses is how to day trade. There's one on swing trading. There's one on macroeconomics and central banking policy. Okay, it's incredible. But anyways, it says, I think that's not the right price. $93 and I don't know the exact price. 50 cents? $93.50. $93.50. Okay. By the way, you knew this yesterday. It's not like it just got drawn. You knew this yesterday. In fact, you knew this on Sunday because we already analyzed this based on price action, not pivot points, but nonetheless. And the short-term goal, look at here. Bullish profit zone aggressive. Can you see that? Can you see that? It's hard because it's overlapped with the monthly pivot. Bullish profit zone aggressive. Bullish buying zone. So guess what happened today? It hit the target and stopped. So I can't tell you if bears are selling. You can't get that kind of data. It's too the kind of data I can give you versus bulls and bears are weekly, not intraday, right? So bulls and bears, I mean, some are taking profit, some are selling. So I can tell you if you are a bear and you sold, okay, your first thing is you're thinking here, and then you're thinking down here. So that's what a bear might be doing right now. They might be. We don't know. But for those that bought here and bought last week and bought the week before, they're very much bullish and they're going to expect price action in their favor, aren't they? They're expecting a higher high. Why would you buy something that you don't expect to make a higher high? Well, Wayne, I'm scalping. All right, good luck with that. So what's the logic of a buyer here? Because notice that there is logic. They bought it here. That's not a random price, yo. That's not random. That's the beginning of somebody's trade plan. And now we're on this price. That's not random. So what are they thinking? Okay. What are they thinking? Would you like to take a guess? What's the price? Let me do it as a poll. Let's do this as a poll. Okay. What price are oil, I'll just say oil bulls targeting? Okay. This month. You should always have a date. Okay, let's do this. 98. 100. 102. I'll give you one more. All right, let's do it. I popped a poll. Please let me know what you think. Dun 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 dun. Ba 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 bum ba 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 bum 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 ba dum bum 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 bum. Okay. Just a few seconds left. 10, 10, 10, 10. 9, 9, 9, 9. 8, 8, 8. 7, 7, 7. 6, 6, 6. 5, 5, 5, 5. 4, 4, 4. 3, 3, 3. 2, 2, 2. 1, 1, 1. Kick busted. Doon, doo, doo, doon. All right, we got enough votes to be statistically relevant. Thank you very much for participating. The answer is, what price are oil bulls targeting this month? They are targeting 105, baby. 105 is the answer. 105. 16% got it right. Okay, 16% got it right. That's what the chart says. Again, it's not my opinion. Okay? If you want an opinion, why don't you ask Millie Bobby Brown what she thinks Brent crude oil will be priced? She's an actress. She's not an oil trader. She's not a technical analyst. If you want opinions, ask an amateur. Okay, that's what my chart says. Now, you might disagree. That's fine. I might disagree too, but that's what that says. Those that bought here and here are thinking that. Thiago, this is Brent. Yeah. So, put it this way, Thiago, if R2 is 98, let's just say we go and tickle 100. That means Brent is probably going to go, right? Brent could go 108 to 111. Probably 108. Okay. Yeah. So that's nice, right? All right, so today is the first day of the Fed meeting. Tomorrow is the FOMC meeting. Do you want to get together for that tomorrow? Do you want to do a special event? Would you show up? Yeah? Would you pay $1? What, $1? Forget it. Wouldn't that be funny? Yeah, I'll show up. I want to. I'll pay it. It'll cost you $1. Ah, forget it. I got other things to do. That made us like, no, I got $2 burning in my a hole in my pocket. Yeah. Well, Maida's very generous. If Maida had a fault, it's that she's too generous. You got to work on that, Maida. Yeah, who's that? Kyle's like, who's the guy that, right? Yeah. Anywho, it cost you a Shiba Inu coin. That would be funny, right? One Shiba Inu worth 0.00000000235 pennies. But it'd be funny if YouTube could collect it. Wayne, where can I look for the latest data or indicators on New Zealand employment data? Oh, Forex pivots. What about my super secret fundamentally based alert service? Huh? Let me give you a sneak peek. You mean you need to do some quantitative analysis? And you want to look at what? New Zealand unemployment data? You mean like that? Under there? Yeah, maybe. I don't know. Where could you get some data like that, huh? Where could you get that kind of data? Oh, I don't know, eh? Oh, guys, I didn't mean it that way. I was just joking. Thank you, though. Yeah. Now I have to go. Now I have to. All right. For some reason, there's always something scheduled that time. But all right, so we'll do something cool tomorrow. Maybe we'll do it here. Maybe I'll do it on the FX Bootcamp YouTube channel. That kind of stuff. Yeah, maybe, huh? So, are you guys subscribed to the FX Bootcamp YouTube channel? I might do it there. Yeah, such a tease. I know. Hey, dude, it's built. You asked. It's built. It works. It's beautiful. Have you gone to youtube.com/FX Bootcamp? I might do it there. Hey, Richard, people ask for help. So I like the information for myself. So I built it for myself because I'm a savage. But I like to share it too because it might be a help to you. So like Forex Pivot says, hey man, I need a help with doing research on employment data for New Zealand. Oh, I got that. Oh, I got that. Yeah, well, I got some unbelievable news coming up soon, Forex Pivots, that will knock your socks off. Okay? So it's going to get a lot better. But yeah, or you can just go annual. So anyways, I got to go, yo. I got to go. This is, I got to go. We're having too much fun. So let me just end it by this way. Where's my, oh, I can't find my, the software. I can't find the software that's running the stuff. Oh, there I am. There I am over there. All right. So thank you for being part of this community. Thank you for doing what you do. Thank you for buying into the idea that this is not about getting rich quick. I try not to be like the kids on YouTube that make Forex fun and exciting. I try not to show yellow Lamborghinis and girls in bikinis. Look how easy it is. Look at all the money I'm making. Of course, that's nonsense, right? So I'm glad you buy into the idea that this is a small business, that the secret to success is creating value over long periods of time, that you like the message of low volatility and consistent returns, that you want to look at your Forex trading as a business. It requires planning and analysis and thought, but most important, the value creation. And that if we look at a market through the eyes or lens of an institutional investor, and the institutional investor says, oh my gosh, look at all the crazy news events this week, we need to be getting out of risky trades, then you understand why the market's behaving the way it is now. But with sound analysis of macroeconomic data, you also see the longer term trends that will likely prevail. Sure, the wind can blow east and west, north and south, but the currents on the ocean tend to go in the same direction over long periods of time. So yes, you got to get the wind correct. And sometimes the wind blows and sometimes it doesn't. That's called seasonality. Sometimes it rains, sometimes it does. Again, seasonality. But there is a true direction of current. It's going to go from here to there. We need to know both where the long-term current is and the ebb and flow of the tide, the seasonality of the winds. We put that together and we want to have smooth sailing over long periods of time. Low volatility, low risk, just sailing in the blue skies with the breeze in our sails, with very smooth ocean, with very small waves. And at the end, we'll have a pleasant journey and arrive at a beautiful paradise of a destination. And we're trying to avoid the big waves, the big swells, the big storms, because, yeah, that's exciting. But best case, we might end up on the rocks. Worst case, we end up at the rocks at the bottom of the ocean. And that risk is just something that is unacceptable to us. So again, thank you for being on this journey with me. I appreciate you in my life. Looks like we're going to do the FOMC decision together tomorrow. So I'm looking forward to that. If you're in my day trading group, I will see you this evening at 4 p.m. Probably talk fundamentals. What else are we going to talk about, right? So, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day, huh? Cheers. Hey, that just happened.